Welcome to The Explainer. In this one, we're going to dig deep into the record-breaking quarter of a financial tech giant and really figure out what it tells us about the future of AI and finance. Okay, let's just jump right in. Financial services heavyweight SS&C just dropped some record-breaking results for the fourth quarter of 2025. So, you gotta wonder, right? With all this buzz around AI totally shaking up the world of finance, how did they pull this off? And what does it really tell us about where they're headed? All right, first things first, let's look at the headline numbers, the big figures that really made Wall Street sit up and pay attention. First up, get a load of this. Their Q4 adjusted revenue, a record $1.655 billion. I mean, that's an 8% jump from the previous year. That's some serious top-line growth right there. And it's not just about revenue, right? Check out the profitability. Adjusted earnings per share leaped over 18% to $1.69. That is the kind of bottom-line pop that really gets investors talking. But you know, revenue and earnings are one thing. For me, the real story is always about cash, and man, did they generate cash. For the whole year, they pulled in almost $1.75 billion in operating cash flow. That is a huge 26% jump, and it gives them so much firepower, so much flexibility. Okay, so the big numbers look great, but what's the story behind the numbers? You know, what's working, and maybe what isn't? And this table, wow, it really breaks it down for us. You can see it right away. Their core businesses, GIDS and GlobeOp, they are just on fire, absolutely surging. But then you look down at the bottom and oof, intelligent automation and especially healthcare, they're really struggling. Those are some tough numbers to see. And that's the real story here, isn't it? It's this tale of two completely different segments. On one hand, you've got their bread and butter financial services just crushing it. That momentum is so strong, it's basically carrying the whole company. But on the other hand, you can't ignore that healthcare number. The company's calling it lumpy, blaming the timing of big deals. But still, a 14% drop, that's definitely something you gotta keep an eye on.
So, all that cash we talked about, it begs the question, what are they actually doing with it all? Let's take a peek at their capital strategy.
And this chart, it lays it all out. Their priority is crystal clear. They are shoveling cash back to shareholders. I mean, over $1 billion just on share buybacks last year. And they've pretty much said, look, we're not doing any big, splashy acquisitions right now. What does that tell you? It tells you they think their own stock is the best deal on the market. All right, let's pivot a little, because you can't talk about any tech company these days without talking about the elephant in the room, AI. So how is SS&C playing defense and offense in this new world? Well, you just have to listen to their CEO, Bill Stone. When he's asked about all these new AI fintech startups popping up, he uses this really great analogy. He talks about their moat. He's basically saying, hey, it's not as simple as you think to just waltz in and take our business. So what's this moat made of, right? Well, it's not about building a wall to keep AI out. It's actually the opposite. It's about their unique strengths. Think about it. They've been doing this for decades in super complex, highly regulated industries, places where you absolutely cannot afford to make a mistake. Their clients are banks, they're hedge funds. They're not going to risk what the CEO called an AI hallucination on some unproven tech. Plus, and this is key, SS&C owns all its own code. That means they can bake AI into their systems in a way that nobody else can copy. All right, so with all that in mind, what's the game plan for the year ahead? Let's take a look at the guidance they gave Wall Street. So the outlook is pretty darn solid. They're not promising the moon, but they're projecting steady, confident growth. We're talking about organic growth around 5%, but look at the earnings per share. They're guiding for a jump of about 12%. That's strong. And they're also laser-focused on efficiency, aiming for a really impressive 40% profit margin by the end of the year. So when you put it all together, what do you get? You've got this powerful, established player that's betting its deep moat, built on expertise, trust, and its own tech, can hold off this new wave of super nimble AI-first startups. They've made a really compelling case, but, the race is really just getting started. And that leaves us with the big question, the one everyone's watching. Is their moat really going to be deep enough?